Good afternoon, traders and investors. Will back here with another one, coming to you with a Sunday night video. And it's that time of the week, guys, again, where we go over the top 5 options plays for the upcoming week. Keep in mind that all of these options plays will be to sell options instead of buying options, meaning that we are writing premium. Now, more specifically, we are doing the put wheel strategy, which entails writing puts at designated strike prices and gaining all that premium in our pockets by the Friday close. More specifically, guys, if you want a concrete example of what this looks like, it's a very, very easy strategy to implement. Just think of selling puts as buy limit orders. So in our theoretical example pulled up on screen right now, I have Microsoft in front of me. And let's say that I wanted to write puts at $400. It's the equivalent of putting a buy limit order at $400 for 100 shares. So if we do sell a put on Microsoft for $400, we would collect pretty much at this point in time $235 in premium. Now, if the stock closes above $400 by the Friday close, we get to keep all of that juicy premium in our pocket and nothing happens. The reason I say it's a buy limit order is because it acts exactly the same. If the stock ever closes below 400, you just have to buy the shares. So it's basically like a buy limit order that pays you regardless of if it gets filled or not. It's a very, very easy strategy to implement, whether you're a beginner, intermediate, or even advanced investor. And if for ever which reason we do end up buying the shares down here, then we will be writing covered calls against the position to further increase the premium that we are farming from this stock and further reduce our average cost in the process. It's a very, very easy strategy, guys, and it's been the strategy that I've been running on the channel publicly now for pretty much the past year, and the strategy that made me over 75% ROI over the course of last year. So with that out of the way here, guys, today's video, we're going to cover a couple of things. Number one, the strategy rules. We'll be going over those very quickly. Number two, we're going to go over the top 5 options plays of last week and see how those played out. And to conclude, we are going to cover this week's top 5 options plays. So without further ado, guys, let's get right into today's video. So starting off with the context of the week, let's take a quick look at what our indexes are doing. As of last week, we have finally recaptured the daily uptrend, and we now have a beautiful weekly leg up in motion. So the markets are a lot more healthy than when we had our fear-driven sell-off back here. That being said, guys, it is going to be a fairly volatile week for 2 key reasons. Number one, on the Wednesday session, we have Jerome Powell coming in with an interest rate decision. Usually that is a market moving event. Now, for this Wednesday, we don't expect him to say anything different than what he's been saying before. The interest rates should not change. If anything, he will maintain the higher for longer in terms of the rates status. Now, it'll be pivotal for us to listen to how he answers journalists' questions in terms of our heightened inflation that we've been getting January, February, and March. If you ask me, though, it's not going to be a severely market-moving event, but it can still have an impact on the sentiment in the markets. And number two, the big thing for this week, guys, it's going to be another huge week of earnings. So many major companies reporting, the likes of Amazon, AMD, Apple, just to name a few, right? You can see all of the big name companies that are reporting this week. So this is also going to increase volatility. So what I've done for you guys is I've picked 5 stocks that do not have earnings. That way we don't have to be concerned with some of the volatile events that happen after earnings, you know, plus 10%, minus 10%. It's really anybody's guess on how these earnings move for a lot of these companies. So for the most part, I've just chosen stocks that just avoid these earnings altogether. However, at the end of the video, I will be presenting a bonus strategy if ever you are the type of person that wants to take the additional risk. I don't recommend it. I never do. But if ever you want to, it's obviously your decision. I will include the strategy that I will be playing for the earnings over the coming week. That was the same strategy that I used last week over about a week and a half. It's been a very, very profitable time so far. So let's get right into today's video, guys. In terms of the strategy rules, to start it off, we're going to go through these very, very quickly, guys. If you haven't seen my longer form video where I talk about the strategy in detail, how I choose my stocks, how I choose my strike prices, right? How to identify these trades. I'll leave a link in the top right corner right now, and I'll leave the link down below in the video description as well. It's about a 30-minute video where I really go into detail about the logistics of the strategy. Now, just to recap a few rules in case you're new. Number one, and the most important rule, please only ever write options on stocks that you want to own and solid companies. If ever there's a company in my list that you do not agree with, please do not trade it, right? You want to be trading high conviction companies for you. Because if ever you get assigned a position after writing puts, you want to be able to manage that position adequately, and you want to be happy with the shares that you are now an owner of. So very, very important rule here. Number two, we're going to want to be writing stocks in monthly uptrends or long-term ranges. All of these rules is to improve our probabilities of not being assigned the stock and collecting premium in our pocket by the week end. So please, let's always try to go for stocks that are in monthly uptrends or at least in long-term ranges. It really just increases our probabilities of not being assigned because our long-term bulls are going to be in our direction. Now, number three, no earnings this week. All of the top 5 options plays, you will see that they have no earnings this week. Earnings is just a very volatile event, guys. So we should just avoid it as a whole if we really want to be consistently profitable in the strategy and end up with no negative surprises. Number 4, so we want to be writing stocks in an area of support or a breakout retest zone. I'll show you those two things combined. So a support area, let's take a look at Autodesk, right? The support area could be something like down here, big support area. So when it comes down here, we want to be writing puts in this area just because the bulls are going to support our trade. The breakout retest trade is when we have a large range right here and we start breaking out of the range in the weekly uptrend, retest our massive previous resistance as support, and then run. This retest area right here is a very high probability trade for the most part. That's why I really like it. So most of these trades on the channel will always be either trades at support or a breakout retest format. These two next lines come one together, pretty much both the same. So we want to be writing on red or flat days, and that ties in with writing at or lower than the expected move. So if you don't know what the expected move on is for a given stock in a week, guys, that's just a probability that Wall Street attributes either up or down for a stock movement in a given week. If you don't know what the expected move is, you can go on this free website right here. It's called optionsai.com. They have a free expected move calculator, and you can see I have Coca-Cola pulled up here. Coca-Cola expecting 2% to the upside or to the downside, and we're going to target trying to write below the bottom end of the expected move down here. It just increases our probabilities of writing below the expected move that we will not be assigned. Number 2 here, right on the red or the flat day, well, it obviously goes in line with our expected move. If Coca-Cola tomorrow drops, let's say to $61 or even 60.7, let's say, it gets us really close to our expected move, and then we can write even further below the expected move, which once again increases our odds. So I will always be writing options, guys, on red or flat days. It just allows us to go even deeper below the expected move and get those juicy strike prices that should not be hit by the market. And now our before last point, we want to be writing between 0.5% to 1% in weekly premium. What that means, guys, is when we take a look at our premium chart here on, let's say Microsoft, right? We want to be targeting strike prices that provide us with at least 0.5% in weekly premium. How you do that math is very, very easy. Just go for half of the strike price in cent increments if you want to do the mental math in your head. So half of 400 is roughly 200. In cent increments here, we'd be looking for $2. It's a very, very easy mental math way of determining whether or not you're getting 0.5%. If you want me to do the math directly, you can just do $2, let's say, divided by 400, and you'll see right there that that is 0.5%, right? So that's what we want to be going for, 0.5% to 1% rule. If we're targeting below 0.5%, guys, it doesn't provide us enough ROI on an annualized basis for us to be taking the trade. And if we go over 1%, it becomes too risky. It's just too close to the current share price. So you might see these juicy premiums right here for Microsoft. Microsoft currently trading around 406, 407. If we go for something that's above 1%, like let's say these right here, right? The 405s, there's only $2 worth of wiggle room on Microsoft, right? That's barely 0.5% for an entire week of trading. So it's just a bit too aggressive. That's why in terms of a refinement of this strategy over the past few years, guys. I've been running this strategy for about 5 years at this point, right? This is really the art of the strategy, is keeping our risk between 0.5% to 1% per week. Over 1%, too greedy. Below 0.5%, not enough ROI. So this is the sweet spot that I've determined most of all the trades when we're taking them here, 90+% win ratio on all those trades. And now lastly, we want to take profit at 90% of the contract value. Since this strategy is so easy, we just write puts on Monday or a Tuesday and just let the premium come out of the options and into our pocket because we are on the side of time decay. So because of that, we set up our options on the Monday or Tuesday session. We don't need to spend 8 hours in front of our charts every day monitoring how the price action is moving. So we want to set a take profit at 90% of the contract value. So if you're not at your computer Wednesday, Thursday, or even Friday, those options just come off the table and into your pocket without you being at the screen. So that is pretty much everything for our strategy rules. Now let's dive right into our top 5 options plays of last week and do a quick recap of how they went. So number 1 was Autodesk. So Autodesk, I'll remind you here, we were looking for anything below our expected move of 208.95. Well, I'm happy to say, guys, that as of last Monday when the stock opened around 215, it did actually free up the strikes below 205. The 207 was freed up, and even the 205 was temporarily freed up as well. So if you were able to write anything between 207 and 205, well below our expected move of 209, you would have ended up with 100% profit in your pocket as the stock closed above it. Autodesk, such a gorgeous, gorgeous trade here, guys. Came down a little bit because they're having a lawsuit against them, but in terms of fundamentals of the company, nothing really has changed. Just a little bit of fear-driven sell-off. That's why we've been targeting these lower $200 strikes. So very good trade as of last week as well. Now, our second stock we were looking at was Palantir. So Palantir, we've been targeting the same area for weeks and weeks and weeks at this point. That's the $21 down to about 19, this green box of support. More specifically, the trade we were looking for last week was trying to get anything below our expected move down here of 19.59. So we were looking at the 19.5 strike and also looking at the $19 strike. Well, I am happy to say, guys, that when the charts open here on the Monday session in the lower $20 range, both of those did free up. The 1950s were available and the $19 were available to be written as well. And if you would have written either one of those two contracts, all of the premium would have once again ended up in your pocket. Extremely profitable position, 100% win there. Palantir ending well above our $19.50 or $19 range. So very nice, another win on Palantir for the week. Now, the third stock we were looking at, guys, was CELH. CELH, one of my favorite up-and-coming retail exposed stocks. They're an energy drink company. Stock has been on an absolute monster of a rally here over the past 2 years as they've expanded their logistics network, and they have a distribution deal with Pepsi, which means that their products get really good visibility. Company also is the top selling energy drink on Amazon for the past 6 months in a row, beating out its competitors of Monster and even Red Bull. So very, very nice company here. And we were targeting this green box of support, which was about $65 down to $60 for our juicy sweet spot to write puts at. More specifically, last week, the expected move was about $65.88. So I was saying if we can get anything below that, potentially $63, $62, it would be a great trade. And lo and behold, on the Monday session, when we open on Monday, down to the $67 range, it did free up not only the 63s and 62s, but anything 64, 63, 62 were all available for our 0.5% rule. And if you would have taken any one of those strike prices in this range right here, well, it would have been a very profitable trade. Another 100% win there. Stock obviously ending well above the expected move of 65.71. So very happy with the way that one played out as well. Now, the fourth stock we were looking at was Elf Beauty. Elf Beauty, we're looking at this one because it's a very disruptive viral brand. They are disrupting legacy beauty brands and having excessively high growth rates without having a lot of cost expenditures. This company does most of its business online, so it doesn't have to pay for brick and mortar stores, similar to its competition like Ulta Beauty or potentially even Estee Lauder. So that being said, guys, we were looking at this nice, beautiful green box of support. You can see gorgeous monthly uptrend, just looking for the monthly higher low for trend continuation, and the bulls really ran away with this one last week. I am happy to say, however, that on the Monday session, when we started the trade right here down in the 157, 155 range, it did free up trades below the expected move of 148. We were targeting 146 or better, anything below the expected move. I'm happy to say that those trades were freed up on the Monday, and the stock had such a gorgeous day on the Tuesday that you could have closed this trade that you would have opened on the Monday. You could have closed this trade on Tuesday afternoon for 90% profit. So very quick in and out trade on Elf Beauty. Never even got down to our support range right down here. Gorgeous trade. So anything you would have written under the expected move would ended up once again in a 100% win. Stock obviously ending in the 180 range, much above our expected move. And the last one we were looking at here, guys, was TSM. Company needs no introduction. the largest semiconductor manufacturer in the world. They had gorgeous earnings a couple weeks back here, and we were targeting the lower end of this support zone. You can see this green box has stood the test of time for TSM for a considerable amount of period back in 2021, and we were looking for this area to hold once again. So the expected move last week was about 122.44. And we were looking for strikes below that. Think of 121, 120, and even 119. So I'm happy to say that, guys, that on the Monday session, we did open roughly in line with last Friday's close. Well, 2 Fridays ago at this point, right? And it did provide us an entry. When the stock was trading around 127, 126, it did free up the 121 and the 120 strike. The premium was a little bit thin, lower than 120, but 121 and 120 were some pretty good entries. And suffice to say, guys, that the stock just rallied thereafter. So if you would have got that entry on the Monday morning session, 121 to 120, you would have been able to close this trade probably for 90% plus profit, even as early as Tuesday afternoon or Wednesday morning. Very gorgeous trade. So everybody that would have took this trade would have been heavily in profit by the end of the week. Another win there. So I'm happy to say, guys, that all 5 of the trades that we presented for you on the channel last week all ended up as winning trades, looking very, very good indeed. Now, with all that out of the way, guys, let's get into this week's top 5 trades, and you'll see that there's a few that are coming back just because they still represent very good ROI and are still very close to our areas of support. So number 1 is going to be Palantir. So before I get into the top 5 stocks, guys, there's so many companies that I would have loved to play this week, except for that most of them have earnings this week. A lot of the companies that have been playing in the past 3, 4, 5, 6 weeks at this point, there was a lot of them that are at juicy support levels, but unfortunately, a lot of them do have earnings this week. That's why I can't really present them to you guys. So all these 5 stocks that I will be presenting you guys do not have earnings, but they're still very solid companies nonetheless. So the first one obviously is Palantir, needs no introduction. We've been playing this one for 5, 6, 7 weeks at this point in a row, the whole time that we've been really, in this lower $20 range, right? So looking very, very good on Palantir. The expected move for the current week now, guys, is 21.52. So we want to be writing strikes, but anywhere below 21.50. Think $21, think 20.5 is going to be the strikes that I'm looking at. The lower end of where we tapped into last week, which is still a very good entry, guys. Huge, huge, huge previous support, nice previous resistance, and we're coming up here into support again. Gorgeous monthly uptrend, looking for the monthly higher low for further trend continuation. So the whole time we're down here, juicy opportunity to be playing Palantir, in my opinion. So let's take a look, guys. What are the options premiums giving on Palantir for the week? And let's go through these strikes together so we can determine whether or not they're paying enough on the 20.5s or maybe even the $20 range. So let's take a look at Palantir here. The expected move, right? 21.5. We want to be below that. So let's take a look at 21. So $21, you can see that we're not quite at 0.5%. 0.5% would be roughly 10, 11 cents on the bid. And we don't really have that right now. So what we'd need to see from Palantir to open up this trade is a little bit of red on the Monday or Tuesday session. If that does happen, guys, it will open up most likely 10 cents on the bid right here. And if for some which reason Palantir has a very negative day tomorrow or Tuesday and opens up, lower $20 range, let's say it tumbles, a good 4% on the open, that may even free up a lower strike in the 20.5. So this week I'll be looking for either the 21 or 20.5 on a little bit of a dip early on in the week. Really going to be looking to get these lower strikes right there. Could be a very interesting trade idea. The same trade that I've been making on Palantir now, as I've said, for pretty much the past literally 4 or 5 weeks at this point, guys. The lower 21 all the way down to $20 range, such a juicy area of support. Now, stock number 2 that we're going to be looking at, guys, is SoFi. And this one is going to be a little bit different, okay? So a little bit of context for SoFi. They have earnings Monday morning at the open. So the expected move for SoFi is quite large at this point. You can see that the expected move is all the way down here at 673. SoFi is a very volatile stock. That's a 14% move to the downside potentially. So we're going to see what happens when earnings comes out, of course. However, we are above a very, very beautiful area of support. This $7 down to about $6.50 range is extremely juicy in my opinion. Now, if we do see SoFi open up down here in the $7 range after earnings, or maybe even at the expected move, $6.70, or maybe even lower, guys, what we're going to try to do is get the lowest possible strike after the earnings move. So watch where the earnings move opens. I have no idea where the earnings move is going to take the stock, and most likely neither do you. It's anybody's guess, right? So whatever the stock does, if it does come down, we have to measure once it's come down, when it opens, how far lower can we get on these strikes? So let's take a look at SoFi right here for that to make sense for you guys. Let me pull that up right now in terms of the SoFi trade. Gorgeous company, by the way. They've just become profitable, not the business they were 2 months ago. They're really ramping up profitability, ramping up the amount of customers that they have on the platform, looking very good. So if we take in consideration here, guys, all of these strikes, we're going to go deep into the 650s and $6 and see what's available there, depending how it opens, right? So in terms of those strikes, we can see here that so far SoFi is presenting in terms of the puts at 650. We don't have them yet, obviously, because the stock is trading at about 785. But if it does open at around 650 tomorrow, or even a bit higher than that, take a brief look at the $6 or $6.50 strike. If you can see, guys, at least 1% on these strikes, meaning if you can see 6 cents on the bid here, potentially even more, that would be a very good trade. So I will be looking for these two strikes specifically, guys, $6.50 and $6 after their earnings. If they are trading above those strikes, I love these strike prices. Very, very cheap for a very beautiful company, in my opinion. So I'll be looking for at least 6 cents on the bid for these. It's a fairly cheap stock, so there isn't much premium, but even 6 cents on the bid, guys, would be 1%, right? So I personally have a SoFi position established already prior to earnings, but I will be looking after earnings as well to see if there's more to be done there. So that is trade number 2. Trade number 3 is a lot more simple, guys. It's going to be Shopify. Shopify does not have earnings this week. The expected move for Shopify is down here at 68.38. So we are still in the context of this gorgeous area, previous resistance, and current area of support. You can see that best on the monthly, gorgeous monthly uptrend. Just looking for the monthly higher low for further trend continuation. Shopify has now cut down a lot of costs, is now back to being fully profitable, and they're really doing a good job of expanding their business a lot in a lot better position than they were back here, really on the way to the recovery story. Our monthly moving averages are down there as well. So this whole area is massive support for this stock. That being said, the expected move is 68.4. So we want to go shopping below the expected move. So let's see if there's something available in the $67, even $66 range for Shopify stock specifically. So let's move into the options table here, and we'll take you guys through those and see if there's any juicy opportunities. So in terms of the 66s and 65s, you can see those right here, right? We can see that as of now, guys, unfortunately, only the $67 has roughly 0.5%, right? 0.5% of 67, you just do, as I said, divide 67 by 2 in your head. Let's call it $34, right? You need to see at least 34 cents on this bid. It's not quite there, but almost. But what I really want to see on Shopify is potentially 66 and 65 being opened up. So if ever Shopify has a little bit of a dip on the Monday morning session, let's say they dip down into $70 range, even $69 range, if it's a bad day for Shopify, that may definitely free up these $66 or $65 strikes. As a quick reminder, we want to be seeing at least 32, 33 cents on these bids right here. 67s are not too bad either. I would just like to see the price come down a little bit and open up further strikes below us here, guys, because it could just be a little bit of a volatile week. Jerome Powell, big tech earnings, right? And this is a tech exposed stock. That's why I want to be going a little bit lower, maybe 66, 65. So keep your eyes peeled on Shopify. If ever we open negative Monday or Tuesday, could be a great opportunity to pick up the 66 or 65 strike. Now, the fourth stock we're going to be looking at is Coca-Cola. This, again, is going to be an earnings play, but we are going to play it after the earnings session. So the only reason why I think this might be a good opportunity is because of what Pepsi reported last week. You can see here that after Pepsi reported earnings last week, the stock dropped about 2.5%, 3% on that same day. And that was because they complained that consumer discretionary income is quite low, meaning that people may not have the money to go out and buy chips and drinks as much as they used to potentially a year and a half, 2 years ago. So we will be making a play on Coca-Cola after they report earnings on the Tuesday morning session. So they report before the market opens. So let's say Coca-Cola, before the market opens, right, has a negative reaction to its earnings and comes down here maybe into the $60 range. Well, our expected move, even with earnings, is about 60.5. So if ever Coca-Cola has a negative morning on that Tuesday morning, we'll be looking at the open, guys. Let's say they come down into the 61 range. How low can we get below this expected move? Can we get 60.5 directly? Maybe even we can get $60. So let's take a look at Coca-Cola here, guys. And we'll see what's going to happen with those strikes. Coca-Cola, by the way, this whole area is so juicy. Take a look on the weekly, guys, how many times this area has acted as support for this stock. Yes, it's blown through it a few times in the past, but these are really one-off events that were in a very negative time period in the market, right? September of 2022, last fall as well, very negative time for the market. Inflation was on the uptrend at that point in time, but as of now, stock has been holding the support area for considerably, pretty much the past month and a half at this point, if not even more, right? All the way since the month of January, pretty much. So pretty much 4 months now at this point. So looking very good. We'll be looking for 60.5 or better on Coca-Cola if ever it has a negative earnings reaction. You can see now, since the stock is about $62, well, there's not much premium there at 60 bucks. I'll remind you, 0.5% rule, we need to see about 30 cents here on the bid. So far, as of now, that's only available on the 61, but earnings has not happened yet. We need to wait for earnings to come out. So this is only going to be a trade that I'm going to be looking at potentially to take after the earnings on the Tuesday morning. If we can really pull down here into the maybe 60, 60.7, 60.5 potentially, that is probably going to open up the $60 strike, maybe even the 59, depending on the size of the move. The target here, even if Coca-Cola, let's say Coca-Cola has a terrible earnings and drops like 3% down to 59. Well, then we want to be targeting maybe the $59 strike right here, or maybe even the 58.50s as low, or the 58, sorry, as low as we can get, depending on the size of the move. That is the name of the game here, guys. So really as low as we can get, depending on how the stock opens after earnings. And now our last stock we're going to be looking at is Oracle. So Oracle also representing a very juicy trading opportunity, in my opinion. Right? Oracle is in the context of a gorgeous weekly uptrend right now. We're just looking for the weekly higher low for potential trend change to the bulls. This whole area right here, guys, this whole 114, 116 section is a very congested area, right? Not only is it going to be acting as beautiful support here, but it has been a previous area, right? You can see support, resistance, resistance, and now coming into it as support again. So very, very congested area to begin with on Oracle. That being said, the expected move for the week is 114.77, right down here where this red line is, coming up on big support levels, and our 200-day moving average at about 112. So this is the area that I want to be looking for here, guys. 113, 112 for a company that's as good as Oracle is a very good deal in my opinion. So let's go shopping together to see if those strikes are currently available. Now, let's take a look here, 112, 113, right, on Oracle, and see how much premium is there. So as we can see right now, guys, there really isn't that much premium available. Oracle is not that volatile of a stock. So you can see the premium, the adequate premium is only really available, not even at the 115s, 116s. That is just too close. So what we need to see on Oracle on the Monday or the Tuesday session, we need to see a pullback on Oracle. If we can see a pullback on Oracle down to about the 114.5 Monday or Tuesday, that will be a drop maybe, or the next 2 days, of roughly about 2%. If we can come down towards the expected move, 114-ish, then that will definitely open up the 113s or the 112s for that juicy premium. As a quick reminder, we're going to be looking for roughly 60 cents on the bid. Even if we have a little bit less than that, I wouldn't mind too much. Even if you see 55 cents on either one of these strikes, I would still probably be going for it. So that is the trade on Oracle. We need to see a little bit of a dip first on Oracle to really open up these lower strike prices. So hopefully that makes sense. So that's pretty much everything that I had for you guys today in terms of the top 5 options plays. Now let's quickly review the strategy that I will personally be running for earnings in case you want to take a little bit more risk. So I call this the 2 times expected move strategy, meaning that I showed you guys this is the expected move on Coca-Cola, right? 2%. So that is called 1 standard deviation, right? If we want to go for 2 times the expected move, or in other words, 2 standard deviations, well, we have to be writing strikes double this expected move. So if the expected move is 2%, we want to be writing 4% below the expected move, right? So let's take, for an example, one that I most likely will be playing this week. Let's take Amazon, for example, right? And we're going to run through that one together. So let's derive the expected move on Amazon real quick. So the expected move, these are all going to be pre-earnings plays, by the way. So Amazon expected move is about 7%, right? You can see that right here. So in terms of percentage change, we want to be writing 14% below this price right here prior to earnings or more, right? So quick glance, we can take the dollar amount. You can see the difference right here on screen, 179.62 down to about 167 bucks. For all intents and purposes, that's roughly $12 away from current price, right? So 2 times the expected move is 2 times $12, that'll be about $24. So can we get some Amazon $24 below the current price? That would be about $155. So let's go shopping if we can find some premium on Amazon for $155. Let's take a look right here, and I'll tell you guys whether or not there's juicy enough premium on it. Usually we want to be looking at 0.5% for that premium around the earnings cycle, right? So even if we go very deep in the strikes, right? Now we're going to go $24 away from current price. Let's take a look how much premium is available there. Well, usually when it's an earnings week, guys, there is a decent amount of premium. It won't be 0.5%. 0.5% would be all the way up here at 160. But if you want to stay really on par with our 2 times standard deviation moves, well, then we may be looking for either the 157s or the 155s. And you can see here, guys, they do pay a decent amount even while being so far away. It's not 0.5%, but it's still good, guys, because keep in mind, the gist of this strategy is we're going to be writing these so far away from the current strike price, right? 179 all the way down to 155. 155 is all the way down here at the 200 daily moving average. So if Amazon opens negative, but not even close to 155 after earnings, this premium will be absolutely worthless the following morning after earnings. So we're not looking to hold these for the whole week, guys. We're literally looking to get in before earnings the same day, hopefully as close to the close as possible to be able to measure these price swings. Right? And we're going to close them the very next morning. The goal is to play as many of these earnings that you want to play and really just rotate the capital. So on Monday, to give you guys an example, I'm playing SoFi and Domino's Pizza and ON. However those perform, I will be closing them right after the open pretty much, and then I'll be trying to make plays on the ones in the after hours. The same, I'll close these ones on the Tuesday and try to make plays, or rather I'll be writing these probably before the open as well. It's just a question of we don't want to hold these through the entire week. We want to be in, and then as soon as earnings are released, we want to be out the next day and just take the profits and move on to the next trade here, guys. So it's a very decent strategy to be running. Obviously a little bit more risky than the pure form wheel strategy, but it's a strategy that I've been executing now over this earnings cycle, and it's a very, very solid one. Indeed on that. So that's just a very quick example. Let's try the type of trade that I would do on Amazon. Now, in terms of Amazon, guys, right? Just a quick reminder, Amazon is earning Tuesday after the close. So what I'm going to be doing is I won't be writing these Amazon puts tomorrow morning. I'm going to wait for Tuesday right before the close, see what price Amazon is trading at, then go to my expected move and then do the math from there. And then I will pick my strike prices that I'm going for. But as a whole, it's always going to be 2 times this number on the screen right now. Those are the strike prices in or around that I'll be writing, and we're closing them the very next day. So hopefully all of that has been educational, guys. If ever you did find it educational, please consider dropping a like on the video. Would really appreciate it for the growth of the channel. Also, if you're new to the channel, consider subscribing too. I'd love to have you guys here. Thank you so much to all 1,200 of you that have subscribed so far. It is now the 1-year anniversary of the channel. I've been having a great time, so let's keep it moving. And then lastly, guys, if you have any questions at all on the strategy, if there was a point that I didn't explain clearly enough, if you have any questions in terms of the wheel strategy or this new earnings strategy that I've been doing over the past 2 weeks, right? Just leave a comment down below in the questions and I'll get back to you tonight. That way you guys can have a great head start for the week. So take care, guys. I will see you tomorrow in our daily market recap that we do every Monday to Friday. Take care and happy trading this week. Peace.